Hello, everyone. I'm back, and I have a really interesting newsletter for you this month, and it's going to be mostly around condos and interest rates. Let's get started. All right, so you can see today's headline. These are my favorite articles, by the way. I'm happy to send them to anybody who's interested in reading them when they come out, but I like to break them down because I really like his take and the data that he uses specifically. His name is Alex. Great guy. All right, today's main story is not the suburb, it's the condo sector. And there's a lot of stuff. At the end, it might get a little technical. I'll do my best to keep it short. First things first, price declines in the suburbs. So you can see here a lot of red. Suburbs are not doing well right now. You can see the one green is the city of Toronto. I'll let you take that in for a sec. Here's why. Sales to new listings and months of inventory. So you can see here, market is weakening, sales to new listings. What's happening is for every, 10 houses that come on the market, how many of them are selling? It was before in December of 2021, it was 12 for every 10 coming on. So we were actually losing inventory really fast, which is bad. The less inventory, the less buyers have to choose from, which makes it more competitive, which means there's more offers, which means people pay more. So we like to see that the sales to new listing is dropping a little bit and months of inventory is growing. Still very low relative to the big picture, but it's getting back up to reasonable levels. All right, let's look at the resale market. All right, here you go. Here's some graphs that go back a little bit further. You can see these spikes on the sales to new listings. Those represent months where more listings were sold than came on the market. You can see we came from a high of 120, if I'm remembering correctly, down to 39 now. A drastic shift from a seller's to a buyer's market. Not something we see very often. You can also see here, months of inventory was incredibly low. And if there's a chart that goes back even farther, a little bit lower down, and you'll see that we're at a multi-decade low and we're now just sort of coming back a little bit. All right. Yes, months of inventory going back to 06. So you can see it's been on a steady decline. We had GFC, 2008, jumped up, fell back down pretty quickly. And then we had 2017, another spike. And then for the most part, the spikes do come back down, as you see, sort of like a volatility measure. But sometimes they don't when we have structural changes in the market. I do imagine that we're not going to come back to 1 month of inventory, hopefully, with interest rates where they are now. I think that kind of solved the problem. All right. Okay. All prices continue declining. I love this graph. Just love graphs in general. Turn your attention to the orange line, which is your average price adjusted for the composition mix, is at 1 to 12, 1,200,000. In the last month's newsletter, I showed a chart that represented the necessary price change to maintain affordability when rates are increasing. All that to say, when rates go up, prices should go down so your monthly payment stays the same. If rates go up and prices go up or prices stay the same, that means that you're losing affordability. So, with the interest rate increases that we have seen to date, a variable is around 2.6%, back from like crazy lows. We would need to see this average come down to 985,000 in order to have maintained the same level of affordability. So you can see that even coming down almost 200,000 or 150,000, we need to shave off another 200,000 to get back to the affordability that we were at a year ago. That's my rant on that. Sorry about that. Overall, Toronto Metro prices are down 10% compared to peak. So benchmark price peak, March 22. Okay, prices are down. We know that. Here's an expanded version of that chart again. So you can see that was the all-time low in our inventory, and it was on a steady decline. And if you were to look up the long-term interest rate chart, it would look very similar to this. It's been in a multi-decade downtrend. You can just see how when money gets cheaper, people flock to real estate. Okay, sales, luxury not doing so hot. That's normal when things get a little bit worse in the economy. We're not there yet, but we could be in the middle of it right now and we won't know until later. But during recessions, we typically do see that the luxury items, not even real estate, but just luxury goods in general, the volume dries up a little bit. You just, the way I think of it is like everybody shifts down. So if you were rich, you'll become middle class, so on and so forth. That's just more resale activity. Okay, months of inventory. Rental market. This was cool for all my renters out there. I love to break down the rental market too. Seasonal pattern is normal. We had the same amount of inventory as we normally would around this time of year. You can see all those faded lines in the back too are going back to 2006, I think. And it is very consistent. Obviously, the rental market, I was working with one client and I'd never seen it like that before. It didn't feel like this, but I'll speak more to that in a little bit. Yes, okay. Prices. Prices dropped during COVID to a low. I had some clients who literally moved just to lock in a better rate. Those days are gone. We are now almost back to reclaiming our 2019 high, and it's starting to feel a lot like that. Yeah, it's tough out there still. If you need a hand, let me know. I'll do the best that I can. Condo sector. Single family versus condos. This portion here is discussing the premium that you pay on a single family versus a condo. And what it's showing right now is essentially that condos are undervalued or single family is overvalued. What could explain that? All right, this is where it's going to get a little technical because he starts to loop in an investment view, right? Investors do make up a segment of the market. I've heard a lot of different numbers. If I had to guess, it would be, maybe 10 to 15% in the resale market. But what I learned recently actually was the new construction market is dominated by investors, like 70% sometimes, up to 80% even, which really blew me away. But it's not shocking because there are just one example that comes to mind is rent increase guidelines. Typically, if you're a landlord, you can't just arbitrarily raise the rent as much as you want to protect renters, right? So landlords have to increase it by the consumer price index, which is released by the government, and it's usually like 1 to 2%. I think the target is like 2%. With any building built after November of 2018, I believe, the rule doesn't apply. You can increase the rent however much you deem appropriate. And there's no recourse. They're allowed to do that. So to me, representing a renter, it's like stay the hell away from new construction, right? It's just problems, in my opinion. Blah, blah, blah. This chart just shows if you're an investor, the cash flow from a condo property. With rates rising and prices not falling, you're losing your cash flow. And that's essentially what I was talking about in terms of affordability. This is a great chart that would represent the affordability. But yeah, so you can see, obviously, not obviously, but this is for fixed mortgages, which are going to be higher than a variable. So I know some investors prefer variables, which means you might be able to maintain some positive cash flow. This part was very technical. Condo prices are holding up better than the overall market, but are declining as well. So average price, median price, benchmark price. So you can see we have seen a significant decline. I'll save my opinions until the end. This group is great, by the way. If you ever see any articles that come through by Urbanation, take a chance, take some time to read it. They come out with a really, really interesting data. So, another rate hike is forecasted. So Bank of Canada raised interest rates 0.5%, and then another 0.5%, and we're expecting another 0.5 increase. Variable mortgage rate is catching up with fixed, but is still significantly below it. This is what I was talking about before. This will give you a rough idea of what those numbers are sitting at. Obviously, they're different for everyone. That's the source, ratehub.ca. It's a really great resource for everything mortgage related. All of this to say, what comes next? Or what do I think comes next? My expectation is rates will go probably no higher than 5%, I would say, before coming back down and settling around. I don't really have an expectation. I think there's a chance that we get back down to zero or very close to it. Historically, Bank of Canada, the Fed, they go too far, which does usually get inflation under control, but that means they need to bring rates down in the future because they went too high. So I have a feeling that that's going to happen. So what I would expect is somewhere between 4 and 5 to be the peak, and then we would come down and maybe end up around between like 1 and 2%, probably. And then in terms of prices, you can see we're comparing 2017 in blue to 2020 in orange. Of course, the markets were different at the time. You can see sales to new listings similar. I just say the market sentiment and some of the more macro and fundamental things have changed. So there's a chance that we continue to see price decline. Again, just all my opinions. But with rates continuing to rise and affordability continuing to get worse, I think prices are going to continue to decline just a little bit. And that's it for me. I love to talk about this stuff. If you ever want to have a chat, give me a call or shoot me a text anytime. And if you're interested in this article or any of these articles, I'm happy. I'll probably end up just linking it at the bottom of this video so you guys can check it out for yourselves. All the best.